It's 2 p.m.
That's how you're concerned. What's the only thing now? It's a night. Present, so that's everyone. Welcome to our live training class. This from view, right? So I'll be taking you in today's class. So today is going to be a continuation of where we stopped last week. So last week uh, we learned about the introduction to the global financial markets, how we come about global financial markets, what we do in the market. So we basically said just like the world markets. I mean, the world market simply means where we buy and sell. So the primary activity of the market is buying and selling. So that's what qualifies a place as a marketplace. So that means in the global financial market as well, it's a place where we buy financial instruments and we sell financial instruments. These financial instruments includes bonds, stocks, cryptocurrency. Now, first market also has to do with exchange of currency, and so on. Commodities as well, like gold, like silver. We also have equities that we also trade on this financial market. So, of course, why the focus of our training particularly is on forex, that's foreign exchange. I mean, the word forex is from foreign exchange. That is, what exactly? I will just go briefly over some of the things we learned last week before we continue with today's class. So we learned that the forex market, like, okay, it's a market whereby we take advantage of the economic performance of a nation against another nation, and we use that to make profit. What does it mean? Last week, uh, so now, for example, let's say, okay, I believe, especially those who are online, probably we are from different countries, but let's say US dollar. Uh, let's say US dollar and Japanese yen, JPY. So now, this, I mean, US dollar definitely refers to the currency of the United States of America, and Japanese yen refers to the currency of Japan. So when we are trading, what we are basically doing in trading is that we are trading the economic performance of dollar against Japanese yen. And what will determine whether we buy or we sell is which of the two currency is doing better at the moment. We don't control the market. So what we simply do is that we follow the direction of the market. We observe what is going on in the market, and we use that to make our decisions. We use that to make our decisions in the market about which currency is actually faring better in contrast to the other currency. So, which means, for example, if the US dollar is doing better economically than the Japanese yen, what we do is that we buy US dollar, and if Japanese yen is doing better than US dollar, what we do is to buy Japanese yen. So that's basically what we do. So what we are doing in forex trading is that we are using the economic performance of the two nations to make trading decisions. And it is now in that decisions that we now make money. So that's basically what forex trading is about. Now, forex trading is a market where we have access to real life, like real time performance of each currency. Now, there's something that I think we were not able to touch last week. Now, we talk about major currencies. Probably we should remember, we talk about major currencies. We have 8 major currencies, right? Now, the 8 major currency are the US, the Great Britain pound, euro, Japanese yen, Canadian dollar, New Zealand dollar, what is Australian dollar, and what major currency that we have. And we said, now, why do we refer to these 8 currencies as the major currency? We said that over the last 50 years, these are nations that their economic performance have been stable and they are tested and trusted. So what makes me just let me just explain something. Now, today, if you search that which nation has the biggest economy as it stands today, the answer you are going to find is China. China has the biggest economy. So even at the moment, China is doing better than United States. Now, so if China has the biggest economy, and I can tell you for a fact, for the past 1 to 2 decades, China has been one of the major economy in the world. So why is China, for example, not that's Chinese yuan? Why is Chinese yuan not part of the major currency, for example? Have you think about that? Now, one of the major reasons is that, of course, the span of time that we use to judge them is not enough for Japanese yuan, for Chinese yuan. Now, another thing is there is something we call floating in currency, floating and not floating. The Chinese government do something, they do not float their currency. That is, for example, now, if you go to China today, the rate of yuan at the moment is not based on the actual market value. It's not based on the actual market value. So what is controlling the rate of their currency at the moment is not their actual economic performance. For example, now if you're in Nigeria, prior to 2023, you notice that Nigeria currency as well. We can have a situation whereby maybe naira to dollar can be, let's say, 200. And this can actually remain for months, not changing. It could be maybe 145, and this will remain for months, not changing. Now, the fact that it is not changing already shows that it is not a real-time performance. That means the market is not showing us what is actually happening per time. Because if it is showing us what is happening per time, the prices are going to be changing at intervals. For example, if you go and check this money, just pick any currency and say, oh, what is the value of this currency to this currency among the major currency? If you check after maybe 4 hours or a day, there are going to be differences, no matter how minor it may be. That shows you that there is something that is going on, there's an activity, there are transactions, thank you, sir. There are transactions that are taking place that is actually affecting the value of that currency. Now, Nigeria prior to 2023, they fixed their currency. They patch it, they just fix it. So it's not revealing their economic performance. So, but presently now, they have floated it. So which means the actual price of naira that you find on the market today now is the actual value of that currency based on their economic performance. Now, that is why the Chinese yuan is not part of the major currency, because their government practically fix their currency. Their government practically fix their currency, and because of that, we cannot trust such currency. We cannot trust such currency to trade because it is not transparent. Do you get what I'm trying to explain? Because why are we confident to trade? To say that, okay, we want to trade this currency against this currency. It's because we can be sure that, oh, this is the actual performance of this currency in respect to this currency. So we can use that information to make a decision. But a situation whereby the information is not transparent, which will most likely also not be true, for us to now jump and use that one to make financial decision is extremely risky. So which is why such currency are not also considered as major currency, and in most cases they are not advisable that it should be traded as well. I hope the explanation is clear. So that's why a currency like China currency is not going to be among our major peers. So the forex market shows us the real-time performance, the economic value of each currency, and with that, we can use it to make decisions. And those real time value is based on informations that are going on in the market. For example, now, let me use the ongoing US Israel Iran war. When the war started, it affected several economies. So there was a hike in price of oil, for example. So fuel increases across board, across different nations of the world. Now, that is a true response to an event that is happening. That is how market is meant to what? To function. Are we clear? Okay, so let's go to today's class majorly. So in today's class, we are going to be learning about base and quote currency in trading. So we just continue. It's just a continuation from where we stopped in the last class. Now, in first trading, we always trade in pairs. That is, we are trading one currency against another currency. So for example, it means if I'm buying euro, for example, in this pair, for example, now, if I'm buying euro, I'm actually selling USD. And if I'm selling euro, I am buying USD. Now, so that's basically what we have here. Now, the first currency here, the first listed currency is referred to as the base currency, and the second listed currency is referred to as the quote currency. Now, the implication of that, we will know it now. Now, the price of a pair is how much the quote instrument it costs to buy 1 unit of the base currency. Let me explain this in a way that we understand it. Let's use US dollar and naira, for example. I think that one is relatable. So let's say we have US dollar and Nigerian naira. So this is the pair. Now this is the base currency and this is the quote currency. Now, what it means is that for us to purchase $1, the price that the market is going to show to us is how much of naira we need to purchase $1. Let me show us let us use a chart to explain something so that it will be clearer. Okay, can we all see this? We can all see this. Now this is Euro USD. Let me clean this. Now this is a pair of Euro USD. Now in Euro USD, Euro is the base currency and US dollar is the quote currency. Now, what it means is now, if you look at this chart, you are going to see numbers here. These numbers are referred to the price of the market per time. This is where it is now. It's a live situation or the current state of the market. Now, this price, for example, now, what it means is that if I want to purchase €1, I'm going to need.
Are those prices for euros or for dollars?
This price now, they are for dollar. That is, if I want to purchase €1, if I want to purchase 1 unit of the base currency, I'm going to need the current price of the market to purchase that.
Current price of the dollar?
Of the market. The price goes up and down. For example, now, let's say, now you can see this and this go up here, right? Now, this is coming down now. So which means the price is moving. It's not the price of the market is not static. It's always on the move. So that means, for example, now at the moment, where is the current market price? We are in 1.16914. 1.16914 is the present price of this pair. What that implies is that if I want to buy €1, I'm going to need $1.16914 to buy €1. So now in some other currency, USD may be the base currency. For example, let me say USD CHS, for example.
Buy the base currency with quote.
Exactly. Let me just use this because of that time. No. It's USD. Okay, now, for example, now, this is another chart, another pair. We have USD CHF. I hope those who are online can understand this as well. Now, USD CHF, the base currency is what?
Well,
The base currency is what?
US dollar.
The US dollar, right? And the code currency is
Swiss.
CHF. That's Swiss franc. Now, that means what we have on this chart at the moment is that for us to purchase $1, 1 unit of dollar, we are going to need this amount.
0.789.
Yes, 0.78968 now is the current price. We are going to need this amount to purchase just 1 unit of this other currency, which is the base currency. So which means we are using the quote currency to buy the base currency. And the price that is showing here is the price of the base currency, of the quote currency in respect to the base currency. Is that clear? Is this clear? Yeah. So now, which means, for example, now, look at this, let's just use this, let's just use something with this particular chart. We see that from here, it has been going up, right? So which means from this point in time to this time, the value of US dollar has increased, right? Has increased. At this point, for us to purchase $1, how much are we going to need? No, this is 0.78400. So if you want to purchase just 1 unit of dollar, we are going to need 0.78400 at this point. Now, but when we get here now, the current position of the market or of the price, we are going to need 0.78974 to purchase just 1 unit of dollar. So that already shows that, now that shows an increment, right?
Yes, it's cheaper than
This is cheaper than it was. So it will only mean that, it will simply mean that the US dollar has gained strength in comparison to the Swiss franc within this span of time. The US dollar has gained strength in comparison or in contrast to the Swiss franc within that amount of time. Now let's go back to what we are doing in the class. So that means for us to, in base and code currency, for us to purchase 1 unit of the base currency, the market is going to show us the price of the code currency that we need to purchase 1 unit of the base currency. And why is that so? It's because when we are trading, we are always buying one currency and we are selling the other. So when you are buying, for example, in USD CHF, for example, if you are buying USD, that means we are doing what? Okay, so yeah, if you are buying USD, that means you are doing what?
you are buying this.
We are selling CHF. If we are buying US dollar,
USD here is the base currency.
is the base currency.
CHF
Is the code currency, yes.
For example, we are buying this currency.
No, what I explained earlier is that I explained that the way the chart shows, the chart is going to show you the prices. The price that you see is how much of the code currency you need to buy 1 unit of the base currency. That's the explanation I make there. Now, in this place now, if in pairs, when you are selling this, you are buying this. And when you are buying this, you are selling this. I could buy or sell either of the two. But the moment I'm selling US dollar, what am I doing? I'm buying CHF. And the moment I'm buying US dollar, I'm selling CHF. Now, it's also important to know that if we have, let's say, this is an uptrend, right? Now, if the pair, let's still stay with USD CHF. What it simply means is that the US dollar has gained more strength than the CHF in the market over a span of time. But if this now turns to this,
It also means that between this time and this time, the CHM has gained more strength. So what also control or determine the movement of the graph or the chart is actually the base currency. If the base currency is strong, we have an uptrend. And if the base currency is weak, we have a downtrend. Are you getting me? If the base currency is strong, we have an uptrend. That means we can buy the base currency. It's going to keep going up. The price will keep increasing. But if the base currency is weak, that means the quote currency will be gaining more power. Are you getting it? And if the quote currency is gaining more power, then the market will keep coming down. I hope this is clear. People online, I hope this is clear. Mark,
Yeah, so what's the base currency here?
where?
In this yes, what's the base currency?
The first listed currency is the base currency, and the second listed currency is the quote currency. So there are some currency pairs that, for example, now earlier we saw Euro USD. So in this pair, for example, now the base currency is Euro, the quote currency is USD. So it's not that maybe a particular currency must be the base currency and one must be the quote currency. No. It's just that whichever one is the base currency determines the movement of the chart. Is that clear? So let's proceed. So the quotation of a currency usually consists of two prices. We have the bid and the ask price. Now, if you open your MetaTrader, because that will be the best way to explain this. If you open your, for example, if you open your MetaTrader, you're going to see something like this. You're going to see something like this, right? You're going to see something like this. Now, it simply refers to the bid price and the ask price. Now, the bid price is the price at which the trader wants to sell that particular pair. And the ask price is the price at which the seller is willing to buy. If you check it, they are never the same. There are going to be differences among them, depending on the pair you are looking at. Some 0.2 different, some 0.3 different. Okay.
Download it on your phone so that it will be much more clear.
If it,
I see better on my phone. I think we did something like that.
on your phone, I'm not sure.
Just download it.
I think we did it on your system.
And when we come to system, we'll give clarity.
So because the phone will help you in following the class more faster. So if you open your MetaTrader, you're going to see, after you see the pair, you're going to see the two prices. The first one is the bid price, second one is the ask price. So the bid price is usually lower than the ask price. The bid price is usually lower than the ask price.
Is there any difference between MetaTrader 4 and 5?
It's just an upgraded version, so you can use any of the two. It doesn't matter whether MetaTrader 4 or 5, it will still show you the same thing. It will still show you the same thing. So we have the bid price and we have the ask price. The bid price is, okay, as a trader, I want to sell. Like, okay, I've noticed that this is a down trade, so I want to sell. So the bid price is the price at which I am selling. And the ask price is the price at which I am buying. Let's move on. So let's use this now. If you open, this is how it's going to look. Is the price you are selling, you are willing to sell as a trader, and the ask price is your buying price. So now look at this, for example. Now this is the outlook you should have, probably on your phone or system. Now you see this is the bid price and this is the ask price for different pairs. So you are going to see that this is lower than this, right? This is 0.85946, and here we have 0.85964. So the ask price is usually greater than the bid price. What is the bid price again?
My price.
No, it's the selling price.
Bid price. Oh yeah, bidding.
Wait, in trading, the bid price is the price at which I am selling. That's the price which the trader is selling. Now, there is something I'm going to explain probably when we get to spread. So I will explain why this is important. There is a reason this is important. It is because of spread. Now, so the difference between this and this is actually our spread. Now, let's do this like this. Now, this spread. The difference now, let's say we want to sell or we want to buy. Now, the sell is going to give you a particular number. The buy is going to give you a particular number. I mean, this is the bid, this is the ask. It's just change of words.
Meta trading now is not giving me that. That's industry that.
Which one? The previous.
See now.
You mean this outlook?
This is what you done left from the last time.
Yes. Mark, please, can you please help him out?
The first one you told us to check that you're comparing. Then you check our meta trader. I want to see this and that.
I don't get the question.
You told us there was a discussion that led us to meta. Where is the app?
It will help you out on it, sir. Okay. Let me continue. So it will help you out to see what we are actually explaining. So now we can see here that we have the bid price. Yes, sir.
You asked us to check something here the other time. What do you ask us to see?
Is it that you check? I mean, the two things I've talked about now, is it that the chart or this?
I was asking you, did you see?
It has to be bid and ask.
Bid and ask.
It has to be bid and ask. Show you. Is the bid and ask not showing?
Okay, this 2 year.
One will be like red, one will be like maybe blue or green, something like that. You can see it now. So the first one is the bid price, the second one is the ask price. So the bid price is the selling price, and the ask price is the buying price. So now the difference between the two is what we refer to as spread.
As what?
Spread.
Spread. I guess PRE.
Yes, spread. So the difference between the bid price and the ask price is what we refer to as spread. Now, this is how it works in trading. Let's say I want to trade. So there is a current price. There is a current market price. Now, the current market price is not the actual price you are going to be buying or selling at. Are you getting me? So if I want to buy, it is the ask price that I'm buying at. And if I want to sell, it is the bid price that I'm selling at. So that is why, for example, if you place a trade for the first time, it may show you negative on some trade. It is because that price is going to be a little bit lower than the actual price that you enter. Do you get me? If you have traded before, if you have attempted trading before, because now this one may not be really clear. If you have attempted trading before, you will get what I just said. That the moment you enter it, it will first show negative because the bid price and the ask price is going to be slightly different from the actual market price at the moment. Just maybe by 0.1 difference. Are you getting me? And that is what that spread. It plays a role in trading. I will just stay like that. So the difference between the bid price and the ask price is what we refer to as the spread. This is what we refer to as the spread. So now let's go to PEEP. How many of us have heard of PEEP before? You have a question?
Yes.
Okay.
If bid price is a selling price.
Yes.
And the ask price is a
buying price.
Buying price. And you check the figure the other time. We have 0.8921 somewhere, and the 0.8925 for ask.
Yeah, the highest the
ask is higher than.
Yes, the bid is usually lower. The selling price is usually lower than the buying price.
You don't want to sell our product?
No. Now let me use a chart to explain. Let me use a chart to explain. Now it's actually, that's the whole point of the class. Let me use a chart to explain. Okay, so this is a chart, right? So let's say I want to buy. Now these are an uptrend, right? So in this market, what we'll do is to buy. We cannot be selling. When the market is going up, what we'll do is to buy. So if you want to buy, the actual market price is 0.78931. Now the ask price, which is the buying price, is going to be slightly below this. That ask price has to do with I want to pick a buy trade. The bid price has to do with I want to pick a trade to sell. So which means when I trigger my sale to buy, it's
You can pick trade for both buy and sell.
for in one currency. With just one currency pair.
I'm only asking.
No, that's what I'm asking.
In the trading market.
Now, for example, let's say this USD CHF now, for example. Can I buy and sell at the same time? Yes. We are going to get to that. Yes, it's just that sometimes it's not really advisable.
But the primary knowledge I want to have now is in the trading market like this.
Yes.
Is that how you pick
a buy
to buy
for one trade?
and
Is
you
it?
make profit like that too?
Yes, that's the whole point. That's the whole point of the trading.
In cryptocurrency, you only pick when it's low and when it go higher, you sell.
Yeah.
So that is
Forex trading.
That's different than just seeing what prompted the question. Yeah.
You can also trade, you can also buy and sell.
Yeah, true. But the key trading is what
the key trading in Forex is that when the market is going up, for example, just like this, what we'll do is we'll buy. Now, if you want to play, okay, if as I'm looking at this now, if I believe that this market will still go down, I can also play a sell. But with just one trade, it's either a buy or a sell. Are you getting it? Just for one trade, though, it's either now for the same currency pair, I could pick one trade to buy. I can go and pick another trade to sell. That's what we call hedging in trading. Probably when we should get there, so probably I will use that one to explain better. So, but now, for example, if you want to buy now, it will show us the actual ask price. The ask price when we trigger the buying option. It is the ask price, that is where our buying will start from. And if you want to sell as well, the bid price is where the selling will start from. So, and it's a little bit lower than the actual market price. That's why that's the place of the slight negative that will come in. Immediately, you trigger a buy or a sell. And that is, I hope that is clear. People online, I hope this is clear as well. Before we move on, because we want to move on to PIP right now. Of course, all these knowledge are actually important. They are elementary to trading, so that when you are now making the decision to do this, to do that, you will know what exactly is going on. I remember when I started trading, then I'll pick a trade, and I was like, why is the trade I just picked already in negative? I was like, what's it? I'll be like, this is ridiculous. Like, are you trying to just the money I want to make? I'm not even make it. You already like I will check the chart again. It has not gone contrary to me now. Like it's not as though maybe the direction I've changed. So why am I starting up at the negative starting point? So what?
You have to wait for like how long before you move from negative?
No, it depends on the market, but it doesn't usually take long, especially when the trade you pick aligns with the movement of the market. It's within a few minutes.
To go up and keep going down?
If you pick a buy and it's go down, we'll get there. We are going to move there. That's where we lose money. That's where we lose money. It happens, yes. It happens. That's just the reality of forex trading. It happens. But just like my boss will say, my Mr. Victor will say, he said that what makes who we can call a professional trader or is a profitable trader. It's as simple as that. So a profitable trader is not necessarily, it's just like a businessman. A profitable businessman is not someone that does not suffer any loss. It's someone that we can say your profit outweighs your loss. That is what it is. So you can say, okay, over the course of a week or over the course of a month, the amount that I make far, far, far outweighs the amount that I lose. Then you're a profitable trader. That's it. So, but that's, I mean, there is no business and there is nothing you're going to do that you are not going to suffer some loss at one point or the other. But what makes you, yes, what makes it profitable is that
Let your profit outweigh your
is the
loss.
margin, yeah, or the ratio to each other. That's what makes it. So let's go back to our class. I hope this is clear for everybody online as well. I hope this is clear for. So now let's go to PEEP. How many of us have heard of PEEP before? I hear PEEP or PEEPs. You say, oh, that's 10 pips, that's 15 pips, that's 20 pips. So let's, I mean, if you are trading or if you have been around traders, you are going to hear that a lot. I mean, pips, that's what traders say every day. So what's a pip? Pip is from the word points, price interest point. Yeah. Pardon me. Price interest point. Now, what I can call a pip majorly is I can say it is the movement of price from one point to another. That's what I can call the simple explanation of what is pip. Now, just like we said earlier, the market is not static. The moment a market is static, it's not reliable. Or let me, unless it is the weekend. No, during the weekend, there are no economic activities going on. So the market is static. But from Monday to Friday, it's expected that at every single time, the market is what? Is active. So we expect a movement in the market, either to the upside or to the downside. So we expect a movement. So that movement of price from one point to another, either upside or downside, is what we refer to as PEEP. Is what is the increment or decrement from one price point to another. That is, from this point to another point. That's what we call a PEEP. It could be an increase and it could be a decrease as well. That's what we refer to as PEEP. Okay, so let me explain this so that it will be a little bit clearer. Now, PEEP is usually valued in an increment or decrement of 0.000010. Now, why is it so? Is that if you look at your MetaTrader, the bid price, the ask price, the current market price, for let me say for coins like USD, for example, you are going to see that it is in 5 decimal places, right?
Four.
No, it's 5 decimal places. You are going to see a small number that is going to be at the last end.
Euro against USD.
Yes, it's going to be something like this. 1 point. I'm not saying that's the actual. That may not be the actual at the moment.
No, but what I have here is 1.4451. That's all.
1.4451.
Yes.
That means I think probably that platform has get rid of the last digits. The last digit is not really, really significant, actually. But it should show it actually. MetaTrader usually shows all of them. Now, now we have 5 decimal places here. The last digit here is usually considered as insignificant. But for the sake of our understanding in this class, that now, if you say that we have one PEEP movement, it is equivalent to 10 points. That is, we can say this one, for example, now, it has moved from here to here. Now, that is 0.00010. Now, that difference is equivalent to one PEEP. Sorry. Sorry, I think we just have a slight light issue. Yeah. So, but let me explain. Let's just pause a bit for this to come up so that we can continue our explanation. Let's just pause a bit.
You don't get the
Okay, Daddy, you see it now. So now, when you see the price at any point in time, for example, for some pairs, now for some pairs it may be different. For example, for JPY pairs, it's usually like um, it's usually like what's going on? 214 point. Now, if you any JPY pair, this is how it shows their own price action or the price per time. These are it shows. But for Euro USD, for example, and major pairs as well, it is usually like this, like just 1.4. Let me just say 41423, something like this. Yeah, it has to be in 5 decimal places for coins like this. Or JPY is 3 decimal places. Now, how we calculate PIP is that now, let's say, let me include this so that, let's say the price moves from, I want to make it as practical as possible. I hope we can all see from where I'm at now. Let's say the price moves from 0.5 to 324 to 1.5 to 334. Now, the difference between this and this is that, I mean, it's simply just 10. Right? Now, the difference is 10. Now, that 10 point is what is equivalent to 1 pip.
Price interest.
That's the price interest point. That's the movement. That means the price have moved by 1 pip, either up or down. It could be either ways. Now, but to save us so that it will not be complicated, these last digits are often considered as insignificant. Because, for example, let's assume that this is 6 or 7 or 8. If we have like 14 and go, it still doesn't change. It's still just 1. So until this change, it is this that we actually focus on. So the first 4 decimal places are the ones we actually deal with, that we focus on in trading. So, for example, that would mean from 32 to like 33, that's one movement. So if it's maybe like, if it's maybe 1.41234 to like 1.41582. Now, if you have something like this, for example, again, this last digit is not really significant in trading. So if we want to calculate our PIP, is the difference between these two. So, for example, what's the difference between these two? This 15.
58 or 38?
This 58.
Okay, not 38.
Not 38.
That'll be like 35 or so.
That'll be like 35. So that means our PIP That means the price have moved by 55 pips. Now that's the movement from one point to another. Okay.
There's what does it differ from the point where I thought about 2 weeks ago?
Which one is that?
No, I think from the
Down
down
up.
to up.
Yeah, it's not really different. What we are just doing now is that I think then we use just normal figure to explain it. So what we are doing now is that we are using the way the market actually shows. We are using it to explain it. That's the only difference now. Okay. So in summary, when we have 10 points, it is equivalent to 1 pips. When we have 100 points, it is equivalent to 10 pips, and 1,000 points is equivalent to 100 pips. Now, let's go to lot size. Now, I'm going to connect this with what we just learned, because the reason we first explain pips is because of where we are going. Now, lot size is, let me say, the percentage of your capital that you are willing to risk or to use per trade. That is, let's say I have $1,000 account. Let's say I have an account of $1,000. So when I want to enter a trade, one of the questions I must ask myself is that how much am I willing to risk out of this money that I have on this particular trade? That is what is going to determine my lot size. The lot size now, it shows that I'm willing to risk this amount of money because I want to make this amount of profit. So the lot size is what helps us in calculating that. Now we have 3 types of lot sizes. We have the standard lot size, we have the mini lot size, and we have the micro lot size. The standard lot size majorly start from 1.0 to 200. Are we together?
Yeah.
The standard lot size starts from 1.0 to 200. At least on our own platform, that's pretty fine. It starts from 1.0 to 200. Now, what this means is that now that 1.0 is equivalent to $10. Everybody loves money, the way it sounds. But let me explain so that I can be clear. What does this mean? This is what it means. Let's say I want to enter a trade and I want to use a standard lot size of 1.0. Now I could use between 1.0 to 200, but let's say I want to use a standard lot size of 1.0. Now, that means for just a single move, for just one pip will be equivalent to $10. Now, earlier we did a calculation earlier that will show the difference between some price. Now, let's say, for example, we have our price move from 1 point, let's say 5342 to 1.53. What was that? Do we have a question? The PIP calculation. We have not really gotten to the PIP calculation.
How do you get 55 pips?
35 pips. Okay. And I will use this one to explain. I think I will just use this to explain.
You have to rewind. Yeah, at 1.0 to 200, where 1.0 is equal to $10.
It's equivalent to $10. I'm going to explain that using this now. Okay, so just follow me. I'm going to explain now. So let's say, now, don't forget again that when you take your normal chart or you pick a trade, this decimal place is going to be in 5 places. But the last digits are not significant. So we'll focus on the first 4 decimal places. Now, so let's say this was the position of our price initially. So, but over time, it has gotten here. So the question is, what is the difference between here and here? That's the movement of the price. What is the difference between here and here? Now, this is 75 now, and this is 42. And that's what? 33. Okay, probably what may seem confusing maybe because the one that is below is actually larger than the one above. But you can just interchange it and do the calculation. You get to the same result. So this is going to be 33, right? 33. So that means this market has actually moved by 33 pips. Now, if I use a standard lot size of 1.0, one pip movement is equal to $10. Which means, now, just follow me. Let us just use this example with it. In this trade now, we have 33 pips movement, right? So what would that be? What would that be equivalent to? That would be $330. I hope this is clear, Anna. As the person that asked the question, I also hope I've answered your question as well.
Wow, so it's not $33.
It's not
$333.
it's $333, yeah.
For that movement, that
For
movement.
this, for on a standard lot size. Now, I also need to explain. Now, because when you are placing a trade, there is a risk attached to it as well. So let's say I already predicted that a market will go up. So if it goes up and I have about 33 pips movement and I'm using one standard lot size, I would have made $330. Now, but if it goes the other way around and comes down, or it does not go in your direction, so that means I will have also lost this amount of money for that particular. If the movement is also 33 pips, I've also lost this amount of money. This is where we have to be careful. So, and as a trader, you just don't focus on the money you want to make alone. There is something we call risk management.
How can you say the loss?
Sir?
How can you say the loss?
Yes, that we are going there. That's where we are going to have stop loss and co. So, but you have to understand it because this also plays a role.
Another question is, you may choose not to use one standard lot.
Definitely. For a standard lot, we have between 1.0 to 200.
You can use 5, 10.
Yes. But for example, if you use 5, for example,
Okay, no, use 10.
if you use 10,
Yes.
that means one pip movement
That than the 3.
is $100
For 10, Abi.
for 10.
So another 3 now.
For 33,
You have 100 times 100.
that's going to be 3,300.
300. That's a lot of loss.
But if it now goes if it goes the other way, you have to think both ways. That is very important.
Instead of thinking both ways, there should be a security government.
There is a security for it, and this is also part of security for it. The understanding of this is part of security, so that this will help you to know. Now, don't forget. Now, let me go back. Let me go back again. You see, we say lot size is the percentage of a capital you are willing to use in a trade. It also implies that from the lot size now, if I'm using a standard lot size of 1.0, for example, I know that one pip movement is $10. So the question will now be, how much do I want to risk in this trade? Am I willing to risk $100? If I want to risk $100, that means, okay, if it won't go against me, by the time it will reach 10 pips, stop. Are you getting it?
You can set it down.
Yeah, we can start it. We are going to get there as well. We are going to get there as well. Now, this is standard lot size. So we can pick either from 1.0 to 200. So, and that is how we calculate it. 1 is equivalent to 10. So which means 5 will be equivalent to 50. 10 will be equivalent to 100. 15 will be equivalent to what? 150 per pip. Whether it goes... Now, we don't determine... Again, I love to emphasize this point. We don't determine the direction of the market. Right? No, we don't. So the market moves, we follow. So if market do the other way, we accept our fate. Now, mini lot size. The mini lot size is basically from 0.1 to 0.9. And 0.1 is equivalent to $1. So that means if I want to place a trade and I use a minute lot size, I'm using a lot size between 0.1 and 0.9. 0.1 is equivalent to $1. 0.1 is equivalent to what? $1. So if I use 0.5 for example, what would that be equivalent to? $5. So still sticking with the trade we use as the example we make earlier. So let's say we now have 33 pips movement. Abi? Let's say we have 33 pips movement. And I use 0.1 lot size. How much have I made? I've made $33. What if I use 0.5?
That's actually my five. Multiplied by that 150, 160 something.
So that's just how we calculate it. So now this also determines how you manage your risk as well. It also determines how you manage your risk.
If you are greedy, you make it. You make it. You lose.
Let me say this. My guy used to say one thing. In trading, don't do go hard or go because you are going to go. Wallahi. Of course, I don't. So you can hear it yourself. If you want to, if you are saying, "Oh, this trade though is that we go out or we go home," it's all in. It's all in. You are going to see it yourself. God's mercy be on you. It's, no, the way it is it's about how your account is. For example, now there are things you can risk on. Oh, sorry. There are things you can risk on a $1,000 account. If you have a $1,000 account, the risk you can take with this account, someone that has $100 account cannot take it. Are you getting it? Now, someone that now has maybe $10,000 account can take more risk than the two of them.
Don't you think the larger the money, the larger the gain? This is the minimal the loss.
Now, this is where now in our subsequent classes we are going to learn about analysis. Now we analyze. We don't just enter the market anyhow. Also, there are things we analyze before we also decide to make a decision either to buy or to sell. So with that analysis, we are able to optimize our gain and minimize our loss. So it's not just that, okay, I've woken up today and I open a chart and I say, this thing is going up. I want to go, let me just put money there. No. That we have to analyze the market and be sure of where it is going. Then we have to make a decision. And in that decision, the decision including how we are going to minimize our loss and how we are going to optimize our gain. So, but the lot size you can use and everything, the size of your account also determines it. It helps you to take some. For example, now imagine, let's say, for example, now someone that asks $100 account, if you use standard lot size of 1.0 that we said earlier, that's just 10 pips. Mm-hmm. If 10 pips go the other way around, his account he has lost all his. I mean, standard lot size, standard lot size we said that 1.0 is equal to $10. Yes. And this $10 is just one pip. Yes. So if you have 10 pip movement, 10 pips movement, that is going to be $100, right? So imagine if all the money I have in my account is $100 and I went to go and pick a trade with a risk of this, it's not wise. It's not wise, right? Yes. Like I will get to the stop loss. I will get to the stop loss. You take a risk of this and it's people you give you 10. Yeah, it is a good. I mean, that's 100% profit if it goes your way, and if it does not go your way, you have blown your account. So, but in trading, you must live to fight another day. I understand what you are trying to say. So there is a way to. For example, but if now look at someone that has this account, for example, if you use one standard lot size, and because the way the market moves, the market does not move in a straight line. Probably I should just emphasize that. The market does not just move like this, then like this. No, the market can move like this. Let me just show you something now. The market is going this way. It can come down a bit, then go back up again.
Yes.
Are you getting me? Come down a bit, go down up again. Now, so all this time that is going down as well, you must make precautions for it. Are you getting me?
Yeah.
So that if it goes down, you are going to put your trade in such a way that you are not taken out of that trade once you are already confident that it's still going to go your way. Do you get it? So that's now where we now talk about how you manage your risk and what determine how much you are going to put in this trade that you want to enter. So let's continue. So for a mini lot size, 1.0 is equivalent to $1. So which means if I pick a trade and I make 0.1, thank you very much. 0.1 is equivalent to $1. So that means if I make a trade and I make, let's say I have 35 pips, that means profits I have $35, and otherwise $35. So we are going to get to how we pick trades and the ratio we use and all those things, so that you will understand how we minimize and optimize our gain as well. So now the other type of lot size that we have is the micro lot size. It ranges from 0.01 to 0.09. 0.01 to 0.09. And 0.01 lot size is equivalent of $0.1, or what we can call 10 cents. So that means, for example, for me to make $1, using this lot size, for example, I will need the market to move by 10 pips. Are you getting it? I will need the market to move by 10 pips. But for someone that is using a mini lot size of 0.1, that 10 pips has already made him $10. For someone using the standard lot size of 1.0, that 10 pips has already made him $100. That's how it is. So I hope this is clear. Those online as well. Do we have anyone with a question before we move forward? So because how we use this to calculate our gain and our loss. That's where we want to go to now. So I want to be sure that it is clear before we proceed. Yeah, of course. Those in class you can just snap this so it will also be of help to you. Yeah. I thought you said someone had a question.
Yeah. Micro, mini, and standard.
We have the micro, we have the mini, then we also have the standard lot size. Should I go on? When you see the question, just let me know. Now, how do we calculate our profit in trading, or in cases where trade does not go our way also? Now, it is the lot size we use multiplied by the pips, the number of pips we made, multiplied by 10. The lot size multiplied by pips multiplied by 10. I used to like to
size.
Yes, let's say we have different lot size, right? Yes. A standard lot size stands for what? 1.0, right? 1.0. So let's say 1.0. How many pips movement? Let's say 33 again. Let's stick with 33 so that we don't have any form of confusion. Multiply by 33. Multiply by 10.
That 10 is $10.
Yeah, the 10 is, it will make it easier because you know that this is equivalent to $10. Now, if we are using 0.1 as well, we already know that this 0.1 is equivalent to what? $1. So that is 0.1 multiplied by what? By 10.
By 33?
By 33. No, by 10.
Why 10 again?
Let me make it. No, let me make it simpler. I think because sometimes this may seem confusing to people. Now, 1.0 times 10 will give you what?
I'll give you 1.
No, 1.0 times 10 will give you 10, which is the $10, right? Then times 33. Is it clear for a standard lot size? Is it clear for a standard lot size? For a mini lot size of where we are using 0.1. Now, don't forget the mini range from 0.1 to 0.9. So it doesn't necessarily have to be 0.1. You can use 0.2, you can use 0.3, depending on what your account is capable of. But let us use 0.1 so that we'll be clear. 0.1 times 10. This will give you what? It will give you 1. 0.1 multiplied by 10. It will give you 1. So that's like the $1. Don't forget again, we said that 0.1 is equivalent to $1. So this is it like this. Then times 33. This is how you calculate it. So because the issue is that for the mini will be 0.01, it's still the same thing, times 10. This one will give you 0.1. Then multiply by 33. Is it clear? Okay, let's do just like a rough practice. Let's pick a lot size outside these three. One standard, one mini, one micro. For example, let's use
10.
no, I don't want us to use a rounded figure like that. Let's use maybe like 7 for this first one. For second ones, let's use maybe just so that we'll know. Let's 0.7 as well. Then let's use 0.07. You can practice what you should now do, you can now practice more by yourself.
So 7 by 10.
Now let's say now still staying with these 33 pips. So if I'm using if the lot size I'm using is 7.0 lot size, how much am I going to make with 33 pips?
That's a lot.
People online, how much are we gonna make? Are you with us?
That'll be like about $2,000.
It's the lot size that determines it.
2010.
Because this is going to be 7 times 10, right?
Yes, 7 times 10 times 33.
Then times 33. So times 10 times 33. How much will it give us? $2,310. Is that the same? Do you get the same thing online? No. Now, this is your lot size. Your lot size is 7. You multiply that 7 by 10. That's already 70. Now, we now say 70 multiplied by 33. Is it 310? Yeah. So that is 2,310. Then let's say we are using 0.7. 0.7, just the same thing, times 10 times 33. What will that give us?
231.
It's going to give us 231. So that means this will probably give us 23.
0.01.
Should give us 23. It cannot be $3.3. It's 0.07.
0.07, sorry. 0.07.
It should be 23.
0.07.
It should be 23.1, something like that.
23.1.
Yeah, it should be 23.1.
So now, how are these people transformed to the money we invested?
This is the money you are making now.
That's what I'm saying. I'm coming on.
Yeah.
This lot size you take based on your capital invested.
Yeah, that is, the magnitude of lot size you can use on your trade.
If you put like $100, like you said.
If you have like an $100 account.
Yes.
Okay.
How will your own profit be different from someone that have $300?
What will determine my profit? How much my profit is and how much my loss might be as well. It's the lot size that I use.
If both of us choose the same lot.
If you choose the same lot size.
$300 and I have $100, both use 1.7.
if both of us, let's say I have you said I have $300 account, you have $100 account. If both of us pick a trade and we use the same lot size, and the trade went in our way, we are going to make the same amount of money.
Irrespective of the value of the account you have doesn't determine.
No, it doesn't change. Now, where the issue comes in is that now I have $300 now. If the market should go the other way around, by the time you are out of the market, I will still be in the market. I will still be in the market. Get it? So it is now, that's why we now advise people that have lower accounts, like $100, $200, $300, you should not take the same risks that someone that has about $1,000 account is going to take. Because if you go the other way, you will be out. The person will still be there. It's easier said than done.
When the horse falls in and the stand up man,
people are different actually. So, but we always advise people to manage risk and not want to get rich. One of the things we learned last week is that trading is not a get rich quick scheme.
If you have in business in here, whether you do the physical don't buy and trade, right?
There is a risk to every trade you are taking. Yeah, there is risk. Now,
or the tendency or the opportunity that when you do it again, of course you have to learn from your
mistake. Then the reason we usually teach like this is that we want people to know what is going on, so that you will know if anything happens in the market, you actually know what the cause is.
Is it possible for someone to lose consecutively first time, second time?
If he's picking the wrong trade.
So
if you're picking the wrong trade, if it's
right,
yes, that's where the skill comes in. If you are skillful in forex, the skillfulness is that you can if you pick 10 trade, for example, let's say 7 is going to go well. That's the skillfulness. Let's try to move on. Now, I hope that is clear. The calculation is clear. So how do we trade? Now, when it comes to trading, 3 things are important: the entry, the stop loss, and the take profit. The entry, the stop loss, and the take profit. What is the stop loss? Now, this will answer some of the question you are asking earlier. Stop loss is you telling your broker how much you are willing to risk with your trade. Now, every single trade comes with a risk. Why? Again, just like I said earlier, the market does not move in a straight line. It moves in a wavy form. So even though the market might still go in your direction, there are times it may slightly go contrary to what you have predicted. So you must make preparations for all those things. So a stop loss is, okay, this trade I want to enter, how much am I willing to risk? So let us use an example. Can we all see this? Can we all see this? Mark, I hope people online can see this as well. Okay. So now this is just like an example of a trade. So we pick a buy here. Our stop loss is going to be below our buy.
Our stop loss will be
below our buy. If we are taking a buy, if you are taking a sell, our stop loss is going to be above our sell. Now, why is it so? Let me just explain. Because this is a beginner class. So the market has been going like this, right? So we know that if a market is going this way, if you want to make money, what do? We buy, right? This is an uptrend, right? So if I want to enter the trade, let's say I want to buy here, my stop loss is going to be below. My stop loss is going to be below. This is my entry. Then my take profit is going to be up. It could be anywhere, but it's going to be up. But in a market, in a downtrend, the market that is going down. So let's say I want to enter the trade from here. If I want to enter the trade from here, I'm saying that, it will continue to sell. So I'm expecting it to go down, to go further down, right? So my take profit is going to be below. This is my entry,
I
and my stop loss is going to be above.
have a question for that. If the market trend is going down, of course, and at that point, I said, if you buy there, for example, we buy at 10 naira, for example,
You see, if the market is going down,
yes.
you sell, you don't buy. This is very important. In trading, we follow the direction of the market.
Is it the market we have already? I don't think we are not getting what I'm supposed to.
No, ask the question.
When it's going on,
Yes.
you say we buy, assuming we buy at that where you put E.
Yes, that's the entry.
Entry point, and we,
Yes,
that's where we put our money.
where we execute either buy or sell.
So that it's coming like buy at 10 naira there, for example. If it's getting to like 5 naira, sell. That means it's coming down.
No, you see, the way trading works is not that maybe I first buy, then what I've now bought, like in normal physical trading, that I buy stocks like this, then I'm keeping it when it's not about to go down and I sell it again. No, it is
How you tell the system people? When you set your stop loss and take profit, is that how you're telling the system?
What would take now? Take profit simply means take profit means that okay, when my trade get to this point, I want to close the trade in profit. Just like the war sands, I want to take the profit. I want to stop here and take the trade. And stop loss means that if the trade gets here, I've lost
That's
enough.
What I want to explain in a layman term.
Okay, probably I don't get the way you are putting it.
I enter with 10 or $10.
Yeah, let's say okay.
So another this
when you enter, for example, you have $100.
Yes.
Let's say when you enter the trade, you have $100. Yes. Your account balance is $100. Okay. So if the trade goes your way, which is your take profit, so that means you have maybe 120, 150. Let's just say, because of the distance, let's just say you have gotten to about $200. I'm just using that as an example. So, but your stop loss now is going to be like, okay, when you get to like maybe 80, using the distance. 20, yeah. So now, close if the market goes the other way, the moment it gets to this point, it's going to close your trade. That means you have lost enough. I'm not willing. So that means when I'm entering a trade, stop loss is like saying, on this trade though, this is the amount I'm willing, I'm afford to lose.
So now let's go to the downtrend.
Now the downtrend.
Can you extend that same explanation amount to the downtrend?
Now the downtrend is the downtrend is going down. Yes. So we believe that this market has been going down. I still expect it to go further down. So my entry, let's say my entry is this point. So I expect it to go down. So my take profit is going to be below.
What's going to be the amount at entry point?
Now it could also be $100. Okay. Now once I'm entering, once the order I'm giving the market is to sell. From year to year, it's going to be in profit. It's going to be an addition.
How? When the market is going down?
I'm selling.
When the market is going down?
Yes. What I'm doing is I'm selling. I'm going in the direction of the market. I'm selling. That's where it's not. That's the.
It's not a comma. It's not.
Like it's just not like. Yes, it's not like that. It's a real life because you are dealing with.
But it's only static. Because me, like when the price is going down, the money should be reduced.
No, you see, let me show you something. The chart we used earlier. The live chart we used earlier. The live chart we used earlier. Now, this is the price. Now, this price increase as it goes up. If this now decide to go down now. Oh no. Okay. So now this is current price position. Now, if this go down now, you see that it is going down. This is what is we are going down here. This is we are coming down. The price is reducing here. But what we are doing is that when we are selling here, what we are buying is that we are buying the other currency. Now, let me go back to where we started from. We said trading is done in pairs. When I'm selling one currency, I'm buying the other. When I'm buying the other currency, I'm selling the other. So when I'm selling this, now in this trade, for example, now, if this trade decides to come down now, what do? I sell. Abi? So I'm selling USD. The moment I trigger a sell for USD, I'm actually buying CHF. That's how the market operates. So hence that movement is going to be in profit for me. So that means because what I'm now using, what I use to make that trade decision is that, oh, I've noticed that the US dollar is now weak and the Swiss franc is now strong. So when I place a sell in this trade, what I'm saying in another way is that I'm buying CHF, I'm selling USD.
All these things are possible to be done in demo.
Yes, you can practice it. You can practice everything in demo. Yes. So that is why whether you are selling or you are buying in trading, you are making profit. But once you trigger a sell now, let's say now this is where the market is. So if I pick my market here, if I enter here, this is my entry. If I execute a buy option here, a sell option rather, sorry, here now, this is my entry. Now you see that the price is going down, but because as this is selling, I'm actually buying as well. So this point is going to be my take profit. My take profit is going to be below. My stop loss is going to be above. But if it's an uptrend like this, my take profit will be above. My stop loss is going to be below. Is it clear?
Yeah. Why take profit is always a bigger margin than
Yeah. It's advisable that you use, at least you're advised to use about 1:2. That, yes, to your take profit. But there is also a way we calculate take profit because we just don't say, oh, there is a place we are expecting the market to get to. That was okay. I expect the market to get to this place. Let me use this as an example. Are you with me? Let's say this market like this. I believe it is still going to go up by 20 pips. I believe it will still go up by 20 pips. So that means if I want to buy, based on, like, I've analyzed it, and based on my analysis, I believe it will still go up to a particular point. Even if it's not going to come down, I believe it will still at least get to this point. So where I am now to where it's going to get to, the distance is 20 pips. So that means if I enter that trade, the pips that I want to secure is 20 pips. Now, how that will translate to money is in what we did earlier. Is the lot size that will determine the money. Are you getting it? So for that 20 pips now, if I use a standard lot size, I'm going to make about $200. If I use 1.0, which is equivalent to $10, I'm going to make about $200. If I use a mini lot size, I'm going to make $20.
Is that where the high risk and low risk come in?
This is where it comes in. Now as I'm taking decision to buy, now then I must make a room for, okay, what if it does not go my way? There is a way you must put it. So we always say that it must be at least 1:2. So that means, let's say I'm now saying, okay, I'm ready to risk 10 pips. Since I'm targeting 20 pips. So that means, okay, if I'm using 1.0 lot size, my target is 200 pips. And my risk is what? Is 100 pips. Is it clear? If I'm using mini lot size of 0.1, my target is 20 pips. My risk is what? Is 10 pips. So if the market go the other way around, once it gets to this point of 10 pips, it will stop. That the trade will not continue. You will not lose more money. So the stop loss is what we use to secure ourselves so that we don't lose unnecessarily or excessively. If you pick a trade and you do not pick a stop loss, if the market go down, you can clear off all your accounts. So that's why it's always advisable that every trade a trader is going to enter, you must always use a stop loss. Don't be too greedy. Have a ratio. So we are going to be concluding very soon. People on live, I believe I'm hoping this is also clear. No, you sir. Do we have anyone that has question?
How to trade?
Losing trade become a winning trade. Azal,
They have to believe that one.
what's time now? We are going to be handing up, sir. Which line are you referring to?
Blue and black, red and blue.
If you pick a trade, that's like the spread. I think I explained it earlier. That's a spread. That's like the bid and the ask price. So that if you trigger a trade, this is a bid price, this is the ask price. Then that's a spread. So I think now stop loss is how much I'm willing to risk in a trade. Take profit is the amount of profit I intend to make in a trade. And my entry is the point at which I'm executing either a buy or a sell. So it's important to know that whether you are buying or you are selling in trading, you are actually doing what? You are making money. But it's advisable that we are very careful with how we trade so that we do not run into unnecessary loss. So what do we do in trading? When the market is going up, we buy. When the market is going down, we sell. This is as simple as that. When the market is going up, we buy. When the market is going down, we sell. We don't trade against the direction of the market. We are not the one in charge of the market. If the forex market, like it's a market that has about $7 trillion. So there is no amount that you are really bringing in that really moves the market like that. So you just have to follow the direction. So of course, this is also an explanation. You enter here, this is your take profit, this is your stop loss. You see now, this is entry, this is stop loss, this is take profit. So that's how we, and if it's a down sell, down trade. No, we have not gone to that point. When we get to that point, we are explaining it. So leverage. Leverage basically means is the ability to use something small to control something big. Now, this is where brokerage firm like PU Prime, for example, that's where we come in. Now, in PU Prime, our leverage is actually presently is 1:1,000. What it simply means is that for every $1 that you are bringing to the market, we are multiplying it by 1,000. That is how whatever trade you are picking can be significant in the market. Are you getting me? Again, the first market has about over $7 trillion that is transacted in a day. So it's the largest market for now at the moment. It's the largest market. One ratio. Now, initially it was 1:500, but now it is 1:1,000. That's the leverage we use at the moment. It simply means the leverage means that we are using something small to control something big. That is, with the money you are bringing to the market, when you, for example, if you now PU Prime now, if you come, the money you are putting into the account into the market with PU Prime is multiplying it by 1,000 in the market, and that is how it can make a presence in the market. That's just what it is. It doesn't really affect your own. It's not that maybe it doesn't mean that maybe your profit will multiply by 1,000 like that. It just means that is how you are able to actually trade in the financial market. That is how your little money is actually be able to make profit or not, because that's what makes it really significant in the market, because the market is very large. Imagine if I'm coming with $10, I'm coming with $50, I'm coming with $100, and I put it in a market of 7 trillion. It's nothing now. If you swallow it, and you will not even know anything has happened. But if the leverage is the broker now help you to multiply it, like amplify the money, that in the trade itself, it holds more value than you actually put into it. I hope this is clear. So, yeah, now, for example, now this is a sell. Please look up. This is a sell market. You see, this is our entry. Our stop loss is here, is up, and our take profit is down. This is the entry. Our stop loss is here, and our stop loss is the risk. You see, I said that we should have a ratio of about 1:2. That's what is advisable. That now at least 1:2 makes sense. And that's why anybody that wants to trade must also be very, very must have self-control. Don't do more than don't be greedy. Yeah, don't be greedy. That's the word. Don't be greedy. So don't go and be risking too much just because you want to gain. Because you are sure that it's going to move 20 pips. You now go and put 10 lot size there. That I want it to make good money. If you switch like this, nobody will answer you. Now, in the market, you have two types of market. We have the bulls and the bear, the bullish and the bearish. When we say bullish in trading, refer to an uptrend. And when we say bearish in trading, now these are just trade terminologies. When we say the market is bullish, it means that this market is in an uptrend, it's going up, we are looking for a buy. When we say the market is bearish, the market is downtrend, is selling, and we are looking for a sell. That's simply what that means. Then, other times in forex, exchange rate, that's the price of one currency to the other. Imagine the money required to open or maintain a trading position. Now, margin simply means, for example, if you open a trade, if you open two trades, for example, if you have about, let me say you have $100 account, $100 account. If you open a trade, if you open one trade, now in that one trade, let's say maybe you are in a profit of $15, and you open another trade, maybe you are in a loss of $30. As long as you have not closed any of the trade yet, as long as you have not closed any of the trade or any of the trade has not yet closed, it does not affect your balance in particular. It is until you close that trade that whatever money you make or you lose in a trade is going to reflect in your account. So that's how it is. So that's why you can enter multi-position. While if the trade is still ongoing, you can still enter multi-position in a trade. But once the trade stops, whether it's now profit or loss, that is going to reflect in the account. So if you say long position is buying a currency pair in anticipation that is going to increase. Short position is another word for selling. Stop loss order, I think we've done that. Take profit, we've done that. Hedging is, let me say it in a simple way. This is done majorly by large firms like banks and co, the big players in the market. Now, what they do usually is that if they enter a trade and they're like, oh, maybe the trade is not going their way, then they can go and pick a counter trade with the same currency to make up for the loss that they are suffering. Now, why it is usually practiced by large firms is that it is dangerous for a normal trader to actually to do that, because you could actually suffer loss in two places. But it is something that is being done by large firms that you will hedge. You pick one trade, then you enter another trade. Like, okay, maybe this. Let me say you pick a trade you believe is going to buy. Then, for that time, you have not closed it, but it's selling. So you're like, okay, you still believe it's still going to buy. You still believe it is going to buy. So you leave the trade open. So, but pending that time that you leave the trade open, you open another trade to sell. Are you getting it? So that's what we call hedging. That one, you're going to be making money on the one that is selling. But once that one change trade as well, you start losing. So that's where the issue comes in. So, but large firms, there is a way, in trading, there is a way you trade that you can actually hedge and make profit. Yes, there is a way to do it. But it's only advisable for large firms. It's not advisable for a normal trade to actually get involved in something like that. Of course, you can get involved because most time people don't listen as well. And whatever the consequence they bear themselves. Liquidity is the ease with which an asset can be bought or sold. Liquidity just simply means how active a currency is at a particular time. Volatility is the variation of price. Now, for example, you hear people say that gold is very volatile. What it simply means is that it's a currency that can move at a fast pace, can move very fast. It has advantage.
In your favor or against your favor?
Fast. Anything, everywhere fast. Whether it's going your way, whether it's not going your way, it's fast. So there are currencies that are very volatile. So, and such currency, it is advised that you should trade them with serious caution. Even it is actually advised that a new trader should not touch gold because of its high volatility. So there are some currencies that are very volatile, that they move at a very fast pace. So they can just jump. That before you open your eyes, you close your eyes, you open it, it has jumped, it has moved back. So, and if it go against you, so slippage is when it's the difference between the expected price of a trade and the price where it is actually executed. Now, this does not really usually happen often, but it happens sometimes. If we have high activities in the market, it could affect the where you put your execution or the blah 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 blah. So, but it's not frequent. And arbitrage, I mean, you don't really need all this one because it's when you are trading currency between different brokers to make profit and co. Now, this one, unless you are AI, I don't really need, cannot really do this one. Yeah, unless you are AI, because you have to be very fast, it has to be automated and so on like that. So, yeah, I think that's all we are going to have for now. So, just before we round up the class, do we have anybody that has any question? Let us attend to that. Now, for those who are online,
did you explain arbitrage?
I explained arbitrage. I did. It's exploiting the differences of the same currency pair between different brokers to make profit. So, but this one is usually not really. It's like AI, blah blah blah, that really can do that. So, and of course, it's also not really advisable because it can go the other way. It can backfire. So,
another question is that AI you mentioned. Some people are trading with AI, right?
Yes, you can trade with AI.
What's the danger in that? What's the lucky?
Now, for example, in PewDiePie, we do trade with AI as well. AI is like, I mean, it's not like it can pick trade. It analyze. Now, for example, you cannot analyze market 24 hours of the day. You cannot do it. But you can train an AI, give it sufficient information to be able to analyze market any time of the day. And when the market is good enough to enter, the AI will trigger the buy and everything for you.
Does it record loss?
Yes.
Or many matches?
Yes, it also all like just like a normal trader, the AI is programmed to use proper risk management and every other thing. So, but because the AI is more, I mean, we are human, we have to sleep, we have other engagements, and so on and so on. So, but with AI, you can actually AI can help you sit with the market 24 hours, can help you go back and say, okay, what are the previous movement of this market? Then what is the likely improvement? Do pay AI for the service. I mean, the service, the AI is owned by PewDiePie. You pay PewDiePie for the service. Now, that is, I mean, if you want to, you can open an account with PewDiePie where AI is actually the one that is going to be helping you to do most of your trading. Yes, it's possible with PewDiePie. So, if you need information,
you can set stop loss and take profit.
yes, AI can do it.
Within the good margin like display,
The ratio and everything, yeah.
Higher ratio for the profit.
Minimum ratio for the loss. Yes, AI will do all that. So we have an AI tool that we use in PewDiePie for clients that may not have enough time to say that they want to sit down with trading, studying charts, and everything. So if you want to do that, yeah, you can also talk to your account manager. So how you are now going to go about it will be communicated. No, sir. If there are any issue, okay. So please, for those who are online, if you have any question, please ask so that we can attend to it. Now, you are going to, in our bio, you are going to see a link in our bio. So for everyone that is online at this moment, I want you to click on the link. I want you to click on the link. Okay, I think the link is not active at the moment. So it is. Okay, so for people that are online at the moment, so we want you to do something. Now, you see, in trading, it's important that you belong to a community where you can learn and that will also help you to grow as a trader. So, and that's what we also do in PU Prime. We offer free training. We also help you to pick trades so that you can become a profitable trader. So, click the link or you can send a message to this phone number that I'm about to call. Now, because we can have people that are not from Nigeria. So, +234 806 173 9229. Let me go again. +234 806 173 9229. Let me go back. Let me go over it one more time. +234 806 173 9229. So you can send group to that number. Send group to that number. Just send group to that number. Someone will respond to you, give you necessary information, and add you to our group. So that group, what are the advantages? We are going to have access to information about our training. We hold training twice in a week. So the time of the training and everything, you're going to have information about that. So we also provide signals that you can use to trade. So that means we give you signals that you can trade with that will help you to become a profitable trader. That will help you to make money, which is the whole point of what we are doing here. And there are other services that we are going to inform you about when you, thank you, sir, when you join the group. So just pause whatever it is you are doing at the moment, join the group either through the link in the bio or send group to the number that I just called. I think the number is also on your screen as well. You can just copy it. Just send it now so that we can reply you and we can also add you to the group. Send group to that number. I believe you are doing that. I believe all of us can hear me. If you can hear me, can you type yes? And if you are doing that as well, can you type yes? I believe this class has been okay. So as well, kindly follow us on our TikTok channel. Just put a follow through. That will also be of help to you to help you to get notification about when we are having classes and so on. So kindly put a follow, give us a follow on our TikTok account so that you can be getting information about our classes as well, and so that you other benefits that are going to come up. We are going to do that as well.
Yeah, can you send the flyer to my? All right. So, in case you're in Abuja, and I'm sure you've learned a lot, so we'll be having a physical seminar on the 9th of next week. All right. So, a physical seminar is going to be holding next week. I'm trying to see if I can display that for you on the screen. So you can see now this seminar is going to be holding at 3J's Hotel. Now, this is a trading summit that you don't want to miss. It's a trading summit that you wouldn't want to miss. Just a minute, so I display this out for you. You are not required to have anything for this. Just a minute, it's going to be sent out on the group. All right, I can see a lot of questions in our group chat. A lot of questions right there, but can you all hear me now? All right. Um, can they hear me now, Mark? Is he unmuted? Okay. So on Thursday, we're going to be having an advanced class. And the advanced classes on Thursday is going to show you how to use a lot of tools to analyze and make money off from the market. So we'll show you how to use the moving average, how to use the MACD to develop signals, generate signals, and to trade live with the market. So make sure you don't miss these sessions. Now, in order for you to get access to all of these sessions, you need to be on our WhatsApp group. You need to be on our WhatsApp group. Now, to be on our WhatsApp group, send yes to 080 6173 7229. So log in your Telegram and you exit it later. So send a message one more time to 080 6173 9229. All right. So now I can see somebody saying you don't really understand the pips very well. That's all right. Just be on this group and you get clarity on that. And when you are added to this group, send a message on the group. I'll personally give you a response. Are you getting this? So one more time, send a message, yes, or send group to 080 6173 9229. So when you send a message to this group, you get added to the group and a community. Just like he had said earlier on, you need a community to grow faster. You need a community of traders like you that will help you grow faster. So send a message to this number and you'll be added to this group. Oh, you want to see reviews? Well, you can easily drop a review right here rather than seeing review. You can easily drop a review right here. All right, so just be on this group, right? You're going to get a flyer of the event. We're going to be sending out the flyer of this particular event. So make sure you're on this group. I'm going to be sending out the flyer. We'll make sure we're sending out the flyer of this particular event to the group so you can participate, register. Now, if you're in Abuja, you don't want to miss out on this. I'll repeat this again. If you're in Abuja, you don't want to miss out on this. You really, really will want to be in this particular event because you stand a chance to gain a lot. You stand a chance to gain a lot. So make sure you send a message, make sure you're on this group so that you'll get more information on how to participate. All right, Larry, you're welcome. You're welcome, Raleigh. You just send a message. It's all right. You'll be responded to. So, Larry, you're in the best place you can be to learn how to trade. Send yes to 080 6173 9229. Somebody will respond to you and take you through the process on how to register and be a part of our trading. Can you? Okay. So when you come in for this, you get to see us personally. Many of you, now very quickly, how many of you are in Abuja? If you're in Abuja, you just put a yes. How many of you are in Abuja? If you're in Abuja, you just put a yes. If you're in Abuja, or probably you're in Nasarawa, some of the neighboring states, maybe Niger, I don't know. I think these are some of the neighboring states we have. Just put on a yes. So I'd like you to just put a yes. Now, how much? It's free, please. You don't have to pay anything. We're giving you the services for free. So we're not asking you to pay a single dime for all of this. We're not asking you to pay a single dime. All right. So I can see a lot of states have been mentioned there: Kaduna, Abuja. Well, if you can make it to Abuja, you don't want to miss out on this. It's going to be a very large business summit, and that is going to be displayed right here. All right. So this is a very large business summit that you don't want to miss out on. Take a look at this. Now, this is a trading business summit. This, this is a trading business summit, and the title of this is Trading Business Summit, like you can see. And for this business summit, we are going to be unlocking wealth through the global financial market. So, if your goal in 2026 is to make money, then you don't want to miss out on this. And if your goal is not to make money in 2026, then I think you need deliverance then. But if your goal in 2026 is to make money, you don't want to miss out on this. You don't want to miss out on this. Make it to Abuja. Now, this is going to be holding in 3 days hotel at Utako. What we'll be doing this at number 31 POW Mafemi Crescent, Utako. Now, if you've heard of this hotel, what's the name of this hotel that Koinonia normally have their services? If you heard of Chida Hotel, now this is very close to Chida Hotel. It's very, very close to Chida Hotel. So this is a business summit you don't want to miss out on. So remember, 3J's Hotel at Utako. 3J's Hotel at Utako. This is one you don't want to miss out. So send a message again to 080 61739229 to be a part of the group, and we'll take you through on how to register. Okay, if you're in Bauchi, you can. If you're in Delta, well, if you're in Delta, if you can still make it there, that is fine. But I think we're going to be streaming this live. Is that possible? So we're going to stream the seminar live as well. So in case you're in Delta, you're probably in Lagos and you might not make it there, we are going to be streaming the seminar live. We're going to be streaming the seminar live. But the only difference is that you might not be able to participate in some of the gift packages, in some of the items you might be giving out, and some of the practical knowledge that might be shared not on the live session. Now, this is why if you're in Abuja, make sure you don't miss out on this. But if you're not in Abuja, you can still join the live stream. Either ways, you still stand a chance to learn a lot and make a lot of money. All right, everybody. I look forward to seeing you right there. Is there any question? Yeah, we have physical classes in Abuja. Check our group. You're going to get, just be on the group, you're going to get a link to where our physical classes hold in Abuja. All right. Thank you, everybody. Remember, send a message to 080 Send a message to that number and you will be informed on how you can join, stream, and be a part of all of this. Okay, everybody. See you all on Thursday. I'll see you all on Thursday. Remember, Thursday is a practical class. We had a very insightful practical class last Thursday. We're going to be having another practical class this Thursday. In case you want to learn how to pick trades, how to open trades, how to make money by yourself, then don't miss Thursday class. Thursday class is strictly for you. It's strictly for you. So see you all there. Yeah, there's a physical class in Lagos. I think that is at August Building, Adeni Jones, number 54B at Ikeja. Number 54B at Ikeja. So that is the Lagos building. So make sure you don't miss out on any of this. We should help you with what? All right, that is all for today, guys. See you all on Thursday. And if you've not given a follow to this page, I'd like you to kindly follow right now. Give us a follow. Sorry. Give us a follow. And one more time, if you're not yet a part of the group, send a message group to 08061739229. Yeah, if it's refusing, just send a message to that number 08061739229, and somebody's going to reach out to you. All right. Thank you, everybody, and see you all on Thursday. Mark, that's all right. Don't worry, don't worry. All right, I can see somebody saying my picture is not there, right? Yeah, my picture is not there. I mean, you've seen me. You're going to see some other part of me again, some other part of us, rather. So I'm going to be there physically. I'm going to be there physically. So, in as much as my picture is not there, you see me there physically live. So, if you have any trading question you want to ask, I'm going to be there. Kehinde is going to be there. A lot of us are going to be there. You can ask question from. So, just make it there. Let's make it there. These are other parts of my persons that also are very good at trading. So you're going to learn a lot from this. But I'm going to be there live. So don't worry. Just be there. You got to see me live.